And I'll do an introduction. Hi, everyone. I want to welcome you to the special session that we're doing with Ron Haycock. This is for our clients that are maybe feeling a little confused, overwhelmed, a little lost as they're going through our once process, own nothing, control everything. And so Ron and I talked about this, and I know that a lot of clients have different questions and different circumstances, but we wanted to just kind of have this question and answer. We're going to do it a couple times a month. You should be, if you didn't get a flyer, you should be getting a flyer. And this first one will be recorded and it will be on our website. So if you get it, please share it. We're always out here to help our clients, but also new clients and new friends that we're getting to meet. So thank you, Ron, for doing this. It's going to be, we're going to just hold it if we can to a half hour. I know that as we get busier with clients hopping on, because I think this is going to be really hot, hot sessions, then it might go a little bit longer. But for right now, and I've got different sessions scheduled. So one in the morning, one in the afternoon, and that, so that people maybe that are working or not able to get on at certain times, they can get on, and again, these will be recorded. So one of the questions that I have is on properties. Okay. And so this is a big one that we get for first of all, what happens when I move or I sell my home from my personal to my LLC, right? What if the bank calls the note? What's going to happen?
If we do this correctly, and your trust is going to own part of the LLC that's going to own your house, there is a federal law out there called the Graham-St. Germain Act. And if the house is transferred to a trust, is basically what they're, specifically what they mention, but it's got to be in a controlled area where only the family is still there. They're still making the payments. It hasn't jeopardized the client's, the bank's position any. If we do that for estate planning purposes, they can't call the loan due and payable.
Great. And then what happens, that because we're able to do this and get a great tax write-off, are we supposed to record it with the, should we record it with the state, or what does that look like?
There are two methods of transferring the title over. Well, not transferring the title, transferring the ownership. One is what they call the contract. It's called a contract for deed. And the contract for deed specifically answers legal and IRS concerns, okay? and the contract for deed said the entrepreneur is selling it to their LLC, and they're not selling it for cash. They're transferring their interest, their equity in their home into the LLC, and it's done by contract. So now their equity will be in the LLC itself, not in the home. And it's done by a contract for deed, which says, this is the obligations, this is what the LLC agrees to do, this is how it's going to work. When the obligation is paid for, in other words, the whole house is paid for, then the entrepreneur will deed the property over to them.
To the
so it's a contract sale. It's called a wraparound contract. But the reason for doing that is because the entrepreneur wants to leave their name on the home. If that's the case, then the contract for deed doesn't have to be, but it can be for more protection. The contract itself would then be recorded as an additional lien against the property with the county.
Okay, and that's one other question I had.
Well, don't ask the next question yet. Because we've still got one other. We've still got one other method.
Oh, okay, go ahead.
Understand, right? The other method is when they actually transfer the title.
Okay.
Right. The first method, if they don't transfer the title, it leaves it in their home. That's proof that they've lived in the home and it's their primary residence for at least 2 out of 5 years, so that they can take advantage of the tax exemption up to $500,000 per couple if they ever sell their home.
Right.
Right. And that's over the profits from that point. Right. But the second way is what they call an all-inclusive promissory note, which would be secured by an all-inclusive deed of trust. When you get a loan from a bank or any lending institution, they have the buyers sign a promissory note. Promissory note outlines the terms of the purchase, what the payments are, what the interest rate is, so on, right? You're going to do the same thing here. But the body of that also says these are the other liens and obligations against the property, and that the buyer agrees to take care of those as well, right? Either currently recorded or which are accruing, such as property taxes. And then that promissory note is secured by a deed of trust in second position to the original lender. And that also outlines terms. And we use what we call a long form contract, which is about 4 or 5 pages long for a deed of trust. Record that deed of trust, which is now a lien against the property. And then the sellers of the property, the entrepreneur, actually does a deed, a warranty deed or a grant deed, depending on the location, to be able to transfer the title to the LLC so that the title is no longer in the name of the entrepreneur. By doing that, that really, really protects the home, because if anybody ever sued the entrepreneur with just the contract, it would cloud the title, but it doesn't answer all of the questions. It doesn't take the potential off of the seller for doing that.
That's, I mean, like I say, that's one reason why we work with professionals. That's why we've got lawyers and so forth, because this may cause a lot more questions. Like, okay, how am I going to do this, or what am I going to do? And that's the one thing about working with Pratt & Lefevre, is that we will walk you through those processes, and we have those professionals that can answer those questions. So
let me give you want a little history on that?
Sure, please do.
In 1979, I brought the first California-style escrow company into Utah.
Oh, wow.
And California does things a lot different than we do and did back then. And it had documents different than what they did here. And so we brought that first California-style escrow, which means that we had to introduce to Utah several documents that there was no laws for.
Oh, wow.
One of them being the all-inclusive deed of trust. And so the state had to implement laws just to guide them, as they said, guide us in what we were doing in 1979. So we are actually the company that introduced the all-inclusive deed of trust into Utah in 1979.
Wow. Yeah. So, I mean, that's what I say. It's amazing. The history that we have, like we say, there's no other company out there that does what Pratt & Lefevre does.
Right.
And that's another reason why I'm so excited. So this other question came up, that there is a lot of fraud with, and so one of the things I like with Nevada is we have a homestead. Where you fill out a homestead paper and you file it with the assessor and so forth. And so it shows that you're the one in the property.
Utah has the same law, but it's not in every area.
Okay, so is there a homestead document that those in Utah should be signing? And if not, you talked about creating that lien. Can you do that with yourself?
Yes.
Can you create that lien and file it so that you're the lien?
You cannot file a lien against yourself.
Okay, but the LLC or
the LLC, because it's arm's length transaction. Remember, that's why we keep everything as separate as they are. The IRS and the law calls them related party rules, especially the IRS. And because the owners actually are one of the members of the LLC, right? We have to make sure that the business itself is separate from the individual and recognized separate from the individual. That's why it's so important to follow the formalities of having a business itself.
Okay, so that's making sure that you're following all of the regulations and so forth.
That's one of the reasons that you can't do this with an S corp. Nice. You cannot do this with an S corp because it cannot be separated. The related parties are there. And in fact, I was reading an article by one of our tax institutes that we belong to. And somebody said, can you rent it to yourself, a husband and wife? And he's the one that espouses renting, I mean, selling your LLC to your LLC, your home to your LLC. He said, nope, you can't do that with an S corp.
Yep.
So
Yeah.
the only way you can do it is if it's an LLC that's completely separate from the individual.
Now, this brings up that question of when you say it's completely separate, when I own, you know, like I own 45%, my trust owns 45%, my husband owns 45%. And when we say we're completely separate, how is it then completely separate from me when I'm the member of the LLC?
Well, you're going to wear two hats, Lisa. You're going to wear Lisa Meyer's hat, and you're going to wear Lisa Meyer's LLC manager hat. So when you do things for yourself, you do things for yourself. When you do things for the LLC, you do them in the name of the LLC, signed as an officer of that LLC, right? Yes. And in addition to that, that's one of the reasons we can't always do this, but we tried our best to do it, is to make sure that not one person owns 50% or more of the LLC.
Yes.
So not one person has control.
So with that, you know, and like I say, I'm throwing out some really, you know, tough ones, you know,
okay.
on that, because we get hit with this. And so but what happens when I've got a person that's single?
It's the same thing. That's one of the areas where it's worked in the past, right? Let me give you an example. Mm-hmm. Because of my position in the company, I want to own absolutely nothing.
Right.
Right. And so we have an irrevocable trust and a revocable trust, right? The irrevocable trust is owned by, the trustees are my wife and my son, but the irrevocable trust is an entity of its own and protects the assets, and the irrevocable trust owns the company and the LLC, right? So the irrevocable trust owns the corporation and owns the LLC that owns the furniture and the cars. The revocable trust is my wife's trust, not completely separate from me. Mm-hmm. And so the only thing she puts in there are her things only.
Yeah.
And she has a limited liability company that her trust and her own. But in both cases, there's only two owners of the trust, or of the LLC. One is the trust and the other one is the individual. And in this case here, it's an 80-20 split. In her case, it's 90-10. Mm-hmm. We've been doing that since 1984, 85, somewhere around that, and been able to do it without any question.
So you can do like an 80-20. There's still you know, I mean, because if you can get that third party, if you've got somebody that's a trusted or.
Well, the reason we can do that is because she's not an officer of the corporation or anything of that nature. So we can do contracts between the LLC and the corporation, and she can sign the contract for one, I can sign the contract for the other. So that keeps it separate. So it shows that it's separate.
Yeah. So one thing I love is like we say, you know, we've got corporate strategic advisors. That's myself, but I always come to you and, you know, and to Marvin and to some of our other specialists for questions, because I am not a tax accountant. I do not understand taxes. I'm not a lawyer. I'm just looking at what they have and let's kind of figure out where we're going. But you're also working with a CFO, you're working with CPAs, we're working with, you know, like I say,
financial planners, estate planners, bankers, mortgage people.
That helps in all of these aspects. So one of the things I want all of our clients to realize is that we're not alone.
Right.
You know, not only us that are working for the client is not alone, but the client themselves are not alone.
And this is not a one-man show. Mm-mm. One person cannot do everything.
No. Well, and that brings up another question. Why can't I go ahead and just do it myself? I mean, you know, I can go.
Go ahead.
Right?
You can. Go ahead.
Yeah.
But I'll guarantee you that 99% of the time you'll screw it up somewhere.
I have. That's why I always say I learned from the hard knocks. One thing you know, we had the Ides of March, and you know, that we've got another one coming, and we've got a couple of them coming up. in
April.
In April in Iowa and Minnesota, or
right? That's correct.
And so make sure you check that out. But one of the things that I loved was Sarah Larson, who works with us, and she's been working with Pratt & Lefevre for over 7 years, I believe, is what she said.
She's our corporate attorney.
Yeah, but she has. It's interesting because she has all these other side businesses as well, and so she completely follows Pratt & Lefevre in what they do. But part of that she talked about is that one of the businesses that she has is a bankruptcy. And from that bankruptcy, and that a lot of times when it comes with business bankruptcy, it is because they've done everything wrong. The business got into trouble, and because they did not have it set up correctly, then it also fell into them as, you think, well, I'm setting up an LLC, but I'm a sole proprietor. And so then the company gets into hot water. Well, that also affects you as that sole proprietor.
Let me give you another example. I have a young man that called me a few months back, and he said, I'm in real trouble. And I said, why is that? And he said, well, I started my company in 2018. I think he called me just at the end of 2021. And I kept my books on a piece of paper, right? And I went and filed my LLC with the state. And I said, really, have you had any meetings? No. Who's the owner? I am. You know what I'm saying? Does it everything on his own. It's called an alter ego. And so after the first year, he filed his taxes in 2019. And in 2020, the IRS came back and said, you owe $6,000 in taxes. He made $100,000, didn't keep the books, didn't have himself organized properly, did everything on his own, and now owes the IRS I don't remember how much it was, several $1,000s.
Mm-hmm. Yeah. We have a newsletter that's going out that says the IRS is not your friend.
Yep, that's correct.
Yeah.
Well, our tax accountant taught that.
He did. He told us that it was a collection agency and it was not your friend.
Right.
And so anyway, so also.
By the way, just for information purposes, we organized Sarah before she came on board.
Oh, I wouldn't doubt it, because that's the same thing. I mean, when I came on board, I had to redo everything I had. And I think that's true for everybody that's come on board working with Pratt & Lefevre. We all had to fix what we thought was going on. Now,
and those who do it themselves, whether they're attorneys or accountants, most times miss something.
Yeah.
And what we do is to make sure that all the T's are crossed, all the I's are dotted before they go into business.
Absolutely. Well, that's a big point, is like, when do you need to do this?
From the beginning.
Yeah. Instead of backtracking.
Right.
Trying to fix it. Yeah. I sent you a case study, or a case. It was a lawsuit that had.
Right.
And we just had a little bit of a conversation, but this company, whether you're small or large or huge, and it was a grain company. Was it Sycamore, or I
think it was Sycamore. Mm-hmm.
Yeah. So they sold their company to Sarah. Was it? Let me make sure I've got it right. So it was. I can't. Oh, come on. I've got it right.
But just give us the gist of it. You don't have to.
Anyway, so what they did was they sold this for a very large amount of money. They sold the company, and it had they couldn't compete, non-compete. And so what ended up happening is they decided that they wanted to do some more stuff. They created an LLC. And I believe that it's kind of like they put it in the wife, but we were talking about it. They didn't do it right. They didn't, and they were commingling.
And that's the whole idea. They're not acting as an individual, it's separate business. They're acting as individuals selling a name.
Mm-hmm.
And so because of that, the individuals were charged, were sued, right?
Yeah.
Not the company.
Yeah. And it's like, okay. And we talked about it. It was like, yeah, they didn't set it up. Even though we've got, a client comes to us, they need to be following not only when it's set up, but make sure that they're doing everything properly. Right. So what does that look like?
Well, let me give you a story, because you know that I had another accounting firm that we had to close down in 2007.
Mm-hmm.
And we closed it down because we were heavily invested in real estate with our clients' companies. So we would invest money in our clients' companies, and that they would purchase real estate and put it into their, but we own 3% of their company. They own 97%, but it was our money. We would invest anywhere between $25,000 to $50,000 in each company so that they could go get the property,
Mm-hmm.
right? Well, when the market started to crash, we had 4 limited liability companies and an LLC, all of them in real estate of one type or another. And we did the accounting, we did the bookkeeping, we did the taxes, we did everything for them. So when the market started to crash between 06 and 07, we had tenants walking away. We had people walking away from their contracts. We couldn't bring money in from anywhere.
Yeah.
And I did everything from every account that I had to keep these properties alive, and I couldn't do it. And I told my clients, I said, if you'll hold me harmless, I'll walk away from my investment in your company, and you can manage it and do what you want to, which they did. I walked away from over $1 million of invested funds, but the corporation closed, and all 4 limited liabilities companies closed because they had no liability, right? None whatsoever.
Yeah.
And so we shut it down. We walked away. I didn't lose my home. I didn't lose my cars. I had nobody sue me. That's what we want to do. To me, that's freedom.
Yeah. Yeah, absolutely. Because you never
and you
know
didn't have to take out, you don't have to take out bankruptcy because you don't owe anything.
Yeah. Exactly.
So you just walk away from it. You resign, you dissolve the company, you walk away. A couple of months later, put a new one in its place and start over again.
Yeah, absolutely. I want to acknowledge that Tiffany is with us as well. She's our National Sales Director. I was like, okay, my mind's gone blank. So welcome. And we are coming to a close, but Tiffany, do you have a quick question or just a say hi? And is she
Speak up now or forever hold your peace.
I know, right? And she might be on another line. And so just kind of checked in.
Okay.
Okay. So this was just one session. Like I say, we've got a couple other ones scheduled in April. And that flyer is going to be going out, but this is recorded, and we'll get that one up on our website. And I've got the flyer that's already, that our Ron Coleman, who does our website and so forth, he'll be getting that up on there as well.
Okay. Well, thanks, Lisa. Tiffany, are you up talking to us now?
I am. Yes. Sorry, I had got a phone call. I just wanted to say I think that this went really well. I can't wait for the next one. And the questions that I have to ask, maybe I'll ask after the recording has stopped since they're internal. But I think that this is a fantastic thing that you've facilitated for our clients, Lisa, and I'm excited to be a part of it.
Great, thank you. And Ron, if you will, as we end this, if you will send that over to me, I'll get it over to Ron.
You got it. Will do.
Okay, so we'll be leaving this one and starting up a new meeting later.
All right, thank you. See you.
Thank you guys. Bye.